Welcome to the Commonwealth Home Ownership Podcast, the real estate investing podcast for Canadians. Whether you're a seasoned investor or just getting started, you've come to the right place. If you're looking for a way to take control of your life through real estate investing, stay tuned and be sure to join us at cwho.ca, your hub for all things real estate investing in Canada.
Thanks, everybody, for joining us. I'm Brad Price, the CEO of Commonwealth Home Ownership. With me, as always, is Phil Wong, the president. And today we have Sherwin Dziwenka with us from Calvert Home Mortgage Investment Corporation. Sherwin, thanks for joining us.
Yeah, and thanks for having me. Really appreciate it.
Great. So, Sherwin, we really are quite excited about chatting with you today because you know, the Calvert Flip program that you guys offer is probably one of the few and far between items out there for real estate investors to utilize to do renovation projects and flip projects. So maybe before we get into the details of that, do you want to give us a bit of an overview of exactly what Calvert is and what Calvert does?
Okay, for sure. So Calvert is, we're a private mortgage lender. We specialize in short-term loans. We've been in business for quite a while. We've been in business since 1975. We started as a mortgage brokerage, so not a lender, but turned into a lender early 80s, and we're a mortgage investment corporation, but better known as a MIC. Everybody knows us as that. So as that name suggests, we have investors that, and I'm an investor as well in Calvert. And so basically, you know, you invest, buy shares in a company, and the profits are paid back to shareholders on an annual basis. There's other types of lending models out there as well in the private space. One is known as syndication, and the other would be known more of one-to-one. So in both of those scenarios, you're lending on an individual property. Syndication means there's multiple people lending on an individual property. One-to-one is one lender lending to on a specific property. So that and the lending is a mortgage, obviously. In a MIC, the better part of the MIC is that it's all pooled together and it's lent across a bunch of different mortgages. So a little less risk, but that's the model that we use as a MIC.
Okay. So for our listeners, if people are interested in actually investing with you, is that an option?
Definitely is an option. So we have investors that, you know, just purely want to, you know, own shares in our MIC. Again, back to, you know, a lot less risk than lending out on individual mortgages because it's pooled and lent out over a bunch of mortgages. So definitely as an investor, that's an option. Bad part is if you're an investor, you can't be a borrower. So there's that side. So some people, you know, as flippers, they want to use our flip mortgage, and so they're borrowers and they can't invest. But sometimes what we find is we will lend out to flippers as investors, and once they're done doing that, then they'll become an investor with us as a shareholder. So it's pretty unique that way with respect to Calvert.
Okay. And sure, and just as out of curiosity, if I wanted to be an investor, like, is there a minimum amount that I have to invest? What kind of returns can I expect from that investment?
That's a good question. So no minimum amount. One thing that we like as Calvert is we like long-term investors. Not to say that your money's locked in or anything like that, but we like people that are going to be there for the long term. Our returns are in the 9 to 10% range, sometimes higher. But we can, you know, we're pretty confident that we can get in the 9 to 10% range. I'm not a dealing rep, so I can always, if someone's interested in investing, I can always put them in touch with a dealing rep that can go over this in way more detail than I can, for sure.
Okay, thanks, Sherwin.
Yeah. So is Calvert across? Do you work across Canada, or are you Alberta based only?
So we're located in Calgary. That's where our office is. We mostly lend in Alberta, and why I say that is because we've just recently started lending in Ontario. So and what we do in Ontario mostly is our flip program. So that's fairly new to us. Just last summer, spring, summer, that we started doing that. So currently lending in Alberta and in Ontario.
No, nice.
So,
Yeah.
sure. What type of lending do you do? I mean, you clarified that you do most of your flip program in Ontario, but so in Alberta, what other types of lending do you do?
What other type? Yeah. So we're a full scope private lender. So we will do things such as equity takeouts. So if someone has equity in their property and they want to utilize it for an investment or for maybe to use it to put back into their company or something like that. So just a pure equity takeout. Another similar type of mortgage is a what we call a debt consolidation. So again, using equity in their property to be able to pay off those higher interest debts. It's often way cheaper to have a mortgage with us than to pay 20% on their credit cards, right? Another example is, term purchase type stuff. We can go into this a little bit more in detail, but we can do things really quickly. So every once in a while, we'll run across deals where someone's looking to close on a purchase or whatever it is, and their lender will, for some reason, last minute pull their funding. Often, these deals will come to us through brokers, and they'll be kind of in a panic. And because we can do things so quickly, we will be kind of a stepping stone. We'll come in, we'll lend, we'll close, allow them to close that purchase, and then down the road they'll get a refinance with another lender with non-private rates. So that's another example. And then the last example, other than the construction and flip that we'll probably talk a lot about down the road, the other example is a bridge type of loan. So bridge loans are basically when you buy a property and you're selling your property, but the close dates don't align. So you're looking at things such as, say I'm buying it, this Saturday and my property closes next Saturday. There has to be a bridge loan in place for that 1 week period. Lots of people like to do that because they like to have time to actually move their stuff between buying and selling. So that's a great way to do it. But if you don't use the right lender that doesn't provide that bridge type of loan, most banks will, but there's other lenders that don't. In that case, we can come in, we can be that 7-day loan for you, allow you to close, and then get paid out when you sell that other property.
What you just made a comment there, 7-day loan. So what are the time periods or terms for bridge loans? Like what's typical, or what's the maximum maybe?
So a maximum amount or time period?
Yeah, the time frame. So if I said, Sherwin, I'm gonna put my house on the market, but I've already made a purchase and we're gonna move out. We're going to sell my current property, and we're basically going to swap principal residences. Is there a maximum length of time that you might say, well, you've got 30 days or 60 days to sell your house that you're in? Like, is there a duration that's?
Yeah. So the answer is no. No maximum time. It's really deal dependent, right? So sometimes, you're going to sell your property or sorry, you're going to move into a property, and because you've negotiated a longer term for possession on your sale. So sometimes that's a month down the road, 2 months down the road. Not very often does it happen that way. More often than not, it's a week, it's 3 days, it's 2 weeks, it's something like that, right? Where again, they're just given themselves some time to move out, get everything cleaned up, and their stuff's already in their new place, right? So again, no maximum time. What we're looking for in a bridge type of deal is that all the conditions are met. So as long as all the conditions are waived, we know they're done deals, the purchase is happening and the sale is happening. That's basically what we call a bridge loan.
Yeah. Okay. That's good to know. What about the equity takeout on a property? So, in this kind of low interest rate scenario that we're in right now with cheap borrowing from the big five, there's a lot of people trying to refinance. They're trying to access equity. They're trying to set up a lower interest rate on a mortgage. In situations where the big banks turn around and say, well, no, we're not actually going to give you that line of credit. Is that a scenario where Calvert can actually provide that line of credit?
Yeah, so we don't per se do a line of credit. So we're not a banking institution where you can run to your bank, throw your card in, pull out $1,000 on a line of credit. But what we can do in a scenario like that is we can provide a mortgage with an open term. So our rates, will change a little bit with an open term because we have no guarantees of how long we'll be in that mortgage, but it allows people to maybe sign up a mortgage for say 200,000 that they have equity in their property, maybe only take 50,000 out right now and have 150,000 sitting there because they might need it, for maybe it's a flip, maybe it's an investment. For whatever reason, some people just like to have access to that. In our open mortgage, they can pay us down or out at any time. And we only charge interest on the portion that they've borrowed. So it's no different than a line of credit, really. It's just the access to funds takes a little bit longer. It's not a simple put your card in the machine and take some money out.
In those cases, then, Sherwin, what loan to value do you typically lend out to in relation to the property?
Okay, so loan to value, great question. It's really dependent on the property. So depending on what type of property and where the property is. So let's say I'm looking at a single family detached in Calgary, my maximum loan to value right now is 75%. So that includes all the mortgages. So if they're sitting on a first mortgage of, let's say 25%, they have access to 50% of the equity in a second mortgage type of loan from us. Okay. If we're looking at a condo, downtown Calgary condo, little bit different because inventory is different. The market is really flooded with that product. So we might look at that at 60 to 65% loan to value. I should also mention that loan to value it will be deal dependent because it will also be based on the strength of the borrower. Mm-hmm. So I might scale back my 70% loan to value to 70, maybe 65, if the borrower has challenged credit, and there's other factors there that I have to consider. So it really is dependent on the full deal where my loan to value ends up.
So how does that differ from the flip program? And I know we're going to get into the flip program here, but I mean, in terms of, looking at that whole scenario, the whole picture of the buyer or the borrower and their property and their situation, does that differ from the flip program?
So the biggest difference is utilizing after repaired value in our determination of what we'll lend. So when we're looking at just an equity takeout and we're going up to 75% loan to value, we're doing an as is value. So here's your property, here's the valuation, here's what we'll lend. If we're looking in the flip program, we're able to, because we have a very unique product, we are able to look at the after repaired value. So we'll look at what you're going to do to the property. We'll look at the property that you're interested in doing the renovations to, get a picture of that end product and do a valuation based on what the end product's going to be. We will lend up to 80% of that after repaired value. There's a couple other things that we will talk about with our flip product. A couple other things that limit how much we'll lend. because we do require a minimum down payment of $10,000. So it just depends on where that all the numbers work out. And I think we're going to go through an example and I can show you all that.
I have some questions about the flip program, but I just want to backtrack just a little bit. In terms of the equity takeout then, what would make a borrower come to you versus a bank? Like what makes you more attractive?
Well, I'll say this right off the hop. We're not more attractive than a bank. I mean, if you're bankable, you should be going to a bank.
Okay.
And there's also B lenders. So there's, the A lenders, we call those banks, and monolines, such as First National, Street Capital. Then we go into B lenders that are like the home trusts, the equitable banks. They lend with a little higher risk, but still have boxes to check. So they're in between A lenders and private lenders. Once you get to the private realm, there is some sort of challenge with your file. Maybe it's you make quite a bit of money, but you write it all off. So an A lender doesn't like that you write it all off, so they won't be able to accept your income from your NOA, right? Maybe it's, you've had a challenging last little while and don't show the income. Maybe your credits got bruised because you had high credit card debt. So the debt consolidation one actually is a really good example where we would be a short-term solution. So not that long ago, Equifax changed their rules, and carrying balances near your credit card limits really affects your credit score. So it can really take your credit score down. And A lenders, if you're not a certain credit score number, you're not going to get an A deal. As well, B lenders also have a certain minimum criteria to be able to get their loans. So we might come in, we'll do that debt consolidation, an equity takeout for that matter, but pay their debts off. Once you pay their debts off, their credit score goes up quickly. It's actually quite amazing how much that makes a difference. Once they get that credit score up, if they have all the other things there, like the income and the serviceability of the debt, refinance is really easy. So in that case, we're a short-term solution. We might be the only solution because no one else is going to even look at the deal. But we like it because, again, it's the short-term nature of it. We always want to be that stepping stone for people to get back to the B or the A lenders. And that's a perfect example of where, normally they're A, but just because of their credit got damaged because of those high balances, that's why they came to us.
Okay. Well, in that case, if A lenders and alternate or B lenders don't take those people, what do you do to protect yourself when you're lending to these people to ensure that they don't default on you as well?
Yeah, that's a great question. So I'm looking at everything just like an A lender, but I'm looking at it with a little bit of a different lens. So what I'm mostly concerned about is affordability. Where A lender says you have to have this service ratio. You can't be over 40%. And you know what, I can't speak to the numbers because I don't know them offhand, but there are certain thresholds that they have to stay under for an A lender to be interested. So for me though, when I look at that and I say, okay, you can actually make your payments as is, but your credit score is so bad and now it's starting to be hard to make these payments. If I come in and I do a second mortgage and I do a mortgage at maybe 12% in second position, pay off their 20% credit card debts at that interest rate, and I amortize it over a period of, let's say, 25 years, I can almost always improve their cash flow significantly. So I'm actually doing the math in the background and saying, okay, you literally can afford what you've got right now, but it's really tough for you and you're racking up your credit cards. Let's say I improve your cash flow by $1,500 a month. You can easily afford that now. Now your credit score is improving and then your broker can take you back to a B or A lender really easily. So almost, if you want to call it a common sense approach,
Okay. Yeah.
because we don't have to check boxes, right? We're a private lender, and we're allowed to, I guess, think outside the box a little bit, but also making sure that we're improving their situation and wanting to be a short-term solution. Like I never get into a deal hoping that they stay with me for 5 to 10 years. That's never ever the way private lenders do. A lenders, exact opposite. They want you for 5, and they want you for the next 5, and so on, right? Because they don't want you to leave. We want to improve their situation and move them on.
Okay. So what I understand is you kind of look at everything on a case by case basis versus an A lender where they just, if you don't fit inside this box, you don't qualify.
Yeah,
That's
and
about right.
when you say case by case basis, I hate saying that, but it's so true, because everybody's situation is different, right? And if we can improve it, and especially so, oil and gas tanked a couple years ago. COVID hit last year. We had scenarios where husband and wife were both working. Husband got laid off, and he was big earner, worked for oil and gas, was making 200,000 a year. He doesn't make that anymore. Instead of and so wife was still working, able to make some payments, but not all of them. And they started racking up their credit cards, right? Now they're in a position where they can't even make those payments anymore because credit card payments are pretty high, right? We come in, we actually pay those credit cards down. We improve their cash flow significantly so that the wife's income could actually make those payments. And then husband gets a job. They go get a refinance done, and they pay us out. So again, case by case, it's just the scenario. No A lender is going to look at that scenario and say, sure, we'll give you this, because the husband's not making what he used to, right? But for us, we see how we can improve their situation, how we can be that stepping stone and move them along, right?
Yeah. Okay, that's awesome.
Yeah.
So can anybody do this stuff, Sherwin? Or is there a minimum requirement, like being a homeowner, for example?
Yeah. That's a good question. So we only lend mortgages. So you need to own a home or be purchasing a home that we can put a charge on title against. We do have some criteria that we will follow. So one other thing is, and it's funny, but being at least 18 years old is one criteria. You have to be an adult to be able to take on a mortgage. And then we go through the 5 C's of credit. And that every lender does that in their own specific way. We talked about A lenders checking boxes. That's what they're doing. They're doing the 5 C's of credit. I won't go into the 5 C's of credit, but basically we're looking at them as a private lender and making sure the deal works for us, and we're helping the borrower out.
Yeah, okay, that's fantastic. So maybe we should start kind of working our way to the flip program here, because we talk about, can anybody do this? So there are some minimum requirements, obviously. Having a property with room for the loan to value to be achieved, depending on the property. What about scenarios where you've got corporations involved? People owning corporations and wanting to do this type of stuff, and then is that the same for the flip programs? Can people utilize the flip program under a corporation, for example?
Yeah, for sure. So we can lend to individuals in our flip program or corporations. Often when people are just doing purchases or equity takeouts, it's in their personal name, often husband and wife, but there's other scenarios as well. In our flip program and our construction program that we'll talk about a little bit, more often than not, they're corporations, and which is mostly due to tax implications. So people want to have it under a corporation, be protected by that corporation, probably pay less taxes because it's under a corporation. If they want to do it in a corporation, we will lend to the corporation. We will require a personal guarantee from the owner slash shareholders of the corporation. So we'll look at it again on a case by case basis, and we'll make sure that the personal guarantee is strong enough that some people will every once in a while will get you can take my wife as the personal guarantee, but the wife doesn't make any money. She's a stay-at-home mom, so personal guarantee isn't very strong. So we want to make sure there's some strength behind the personal guarantee, but more often than not, it's really easy to lend to the corporation.
Okay, so let's look at this from a new investor perspective. So for any new investors listening that are thinking about getting into the flip game, maybe they've been in construction before, or maybe they haven't been in construction, and they come to you and they say, look, we want to start doing flip projects, and we found a property, and we want to go purchase it, and we want to work with you guys. What are you going to be looking for from somebody in that scenario?
Right. So in our flip program, what I always look for is their ability to get to completion on two fronts. One, do they have the money to get to completion? And again, we'll talk about that a little bit more. To have the funds to do the renovations and carry the mortgage. But the more important one, in my opinion, is always, do they have the ability to do the renovations? It doesn't mean they have to do the renovations. They can use other people. They can use contractors, and that's okay. If they have experience, and sometimes, like, some of my best flippers are people that have one trade. So they're actually working for somebody else that are doing flips and want to do it themselves. So they come to us and they say, hey, look, I want to get into this. Me and my buddy Bill and my buddy John, they do, one's a plumber, one's an electrician. I'm just a general guy. I'm going to do the rest of the stuff. Together, we're going to do this. So I'm going to ask them questions about what they've done in the past, show me some examples. So we'll suss that out and make sure that we feel comfortable that they have the ability. Once we do it once, it's really easy moving forward after that. That initial deal is always that lots of questions, show me what you've done, and it's not only for our purposes, it's for their purposes. Our flip program is designed such that we only want to lend if there's profitability. So if I get a sense of people don't know what they're talking about or know what they're doing, it's really hard for me to want to get involved with them. So again, we suss that out. But I'd say in the 6 years that I've been with Calvert, the people that come to us that want to do a flip, they have that experience or have that the contractors in their back pocket that are going to get it done for them. So that conversation it's usually easy to get through.
Mm-hmm. What about the financial component that comes with that? I mean, because it's good to be able to do work yourself, whether it be all of it, some of it, what have you. But what about the financial requirements for those people that are looking to either do it themselves or hire a contractor? Because I mean, if you are going to do work yourself, you're going to realize some cost savings on the labor front and maybe mark up on materials. But you're going to have the capital to purchase those materials. And then if you're looking to hire a contractor, you're going to have a little bit more money available to go and do that. So is that something you're looking at? And when you're asking those questions, is who's going to actually do the work? And then are you weighing up the cost of the renovations for that project?
That's right. So when as I talked about the ability to get to the end of the project, so the monetary part of it, I'm going to ask, a potential client for their renovation plan. I'll ask for their budget and I'll ask for their timeline. Sometimes it's a quote from a contractor, which is fine. So I know the total cost, or at least or a close cost, because there might be overages. But if it's just directly with the flipper, they will provide their rental plan, budget, and timeline to me. What I'm going to do is, again, I'm going to determine that after repaired value, ensure there's profitability, but it also allows me, and I think we'll talk a little bit about our flip analyzer. Right in there, it shows how much money is needed to get to the end of the project, which includes the rental budget, the down payment, as well as all the carrying costs, which include our payment as well as any utilities along the way. Just to add to that, all those costs you can present those in different ways. So one way is cash. Like some people have a lot of money in the bank, and that's the easiest way to do it. Some people have a HELOC on their primary residence, and they're going to borrow against that, and then they're going to pay it back. Other people just have a line of credit, so it's not on title or anything like that. It's just a generic line of credit. Other people, one of my best flippers has a Home Depot credit card. They rack that card up every project and they pay it off every project. And that's something I consider. But I also consider the fact that as they're racking it up, that's another cost to them, right? So I'm considering all that when I'm making sure that they have the ability to get to the completion of the project.
I think that's a really good point you mentioned there, because if you are using credit, whether it be line of credit, credit cards, and let's say the project duration is 4 to 5 months, and you're going and expending 10, 20, 30, up to $100,000 for a renovation, maybe the cost of that, let's just say 50% of that is material and the other 50 is labor, for example. If you've got $50,000 in material costs that are sitting on lines of credit at 7%, 5%, depending on if it's a HELOC or unsecured, plus you've got a Home Depot credit card, and I know because I've got one, you're sitting up at around 22% interest, you've got to factor that into your carrying costs, because that can add, in excess of $1,000 a month to your project, and your profitability is going to be reduced by that same amount based on the duration. So I think that's a really good point.
Yeah, and what you said is exactly why we see some of these projects fail. Where somebody just didn't consider that, and then all of a sudden they didn't make what they wanted out of it. So one of again, back to Calvert, one of our key criteria is profitability. And we're going to dig into it to that level to understand how you're accessing your funds, and is there a cost to that? We're also doing the cost of our monthly payments. So all of that is a carrying cost. And so when we do that analysis, if there's still a good profit, we want to be involved. If there isn't, we're going to have that conversation and say, maybe this isn't the project, or maybe you need to buy it for less, right? So because we say this all the time, every purchase is a good flip as long as you get it at the right price, right? Like that, it's all based on price, because the end value after what you're going to put into it, if you get it at the right price. So if we can manipulate some of those things and they can get it at the right price, there's still profit there, then we want to be involved.
I think that's one of the best parts of your, call it a dual function calculator that you have, the spreadsheet is, and this is maybe probably the best way for new flippers to start, but looking at the maximum purchase price rather than the other way, which is adding everything up and then looking at it from that perspective. You've got a way to analyze a property, and it will tell you the maximum purchase price that you can purchase that property for, rather than the other way. Because it is, somebody that does this, it is time consuming to go through and put in all the specific items, unless you've built a system or a process to enable you to do that a bit quicker. So having the ability when you're starting out to see the numbers more often, it's a good way to kind of work through that maximum purchase price route.
Without a doubt, and because everybody that is doing something, they're doing it for a reason, and they have a goal, set. and it might be, I'm going to do this. This is going to be a 3-month turnaround. I want to make at least 25 grand on this property. It might be more, it might be less. But whatever that goal is, you set that number in there, you put that $25,000 profit, and then you work from there. And then that gives you the maximum purchase price, right?
Mhm.
We always say numbers are so important in flipping. You got to know your numbers. You got to be good at it. We talked earlier about the first timers. Sometimes what I like to do is have a little more profit with first timers, because I find that just learning, there's numbers that you forget about. There's numbers that you don't quite do as good as you will do when you have some experience, right? And often that's with the rental budget. So those are the things, so if there's a little more, if you want to call it meat on the bone, it's better for those first timers, and then they get experience, and then their numbers get more tight, and then their profits get better down the road.
In terms of those first timers, Sherwin, does Calvert sit down with them, say they present you a plan, and you feel it's not quite dialed in? Would Calvert sit down with them and try to help them dial that in, or would you tell them to go back to the drawing board, come back with a better plan?
Are you talking about rental plan?
Rental plans, yeah, sorry, rental plans.
Yeah. So oftentimes we can, if the property's listed on MLS, we get a fairly good sense of what's going on and what needs to be done.
Mm-hmm.
And if we can see that the flooring needs to be replaced, but the budget comes in and there's no budget for flooring, we'll have those questions, and we'll have that conversation back and forth and see, okay, so what are you doing? And then oftentimes it's, oh no, well, that number's in here. Or, that number's in the kitchen and the bathroom generic number that we put in there. So we just suss that out, make sure it makes sense.
Mm-hmm.
Every once in a while, we'll get people that their numbers don't quite make sense. I don't know a good example, but doing granite countertops throughout the house, and they put a $1,500 bill on that, and you go, that doesn't quite make sense.
That's the laminate granite.
What's that?
The laminate granite.
Laminate granite, yeah. And you're right. Those are the questions. So where are you getting this? Are you sure it's granite? And so you want to suss that out, because one of the things we really need to know to determine that after repaired value is, what are you actually putting in this place? We need to get create a picture of it, and then get that end value, so that we're lending on that. So yeah, there's a lot of conversations. I mean, even to the detail of what are you buying? So, some people will buy the biggest house in the community.
Mm-hmm.
We strongly recommend that you don't buy the most unique house in the community. It's often hardest to sell. You're going to want top dollar, yet that community doesn't allow for that dollar. You're going to have to wait usually longer to sell it, because somebody will eventually buy it at that price, but it might just take longer. You might get lucky and sell it fast, but that's not usually the case. So we like, buying for the community, the generic, the average property in the community. We like when flippers renovate to the community. There's some communities that you don't put granite and hardwood in. There's some communities that you have to do that. So we want them to be, renovating to the community. So we're going to look at things like that. We're also going to look at things like, when we do our end value, and we haven't talked about that, but we do that internally.
Mm-hmm.
We look at the inventory of the community. What are they going to be up against when they're selling that property? If there's a flooded inventory, we really want to caution them and make sure that they are aggressive in their pricing, because if they're up against a lot of competition, it's tough, right? Right now, inventory in Calgary is awesome. Things are selling above list. It's a unique time and not something that I expected coming out of COVID, or I guess we're not out of it, at this part of COVID. So we're a little confused, but we like it, but so those are the details that we'll go into when we're analyzing a deal, and we will pass that along to the borrower, to the investor, because we want them to make sure that, we want them to know what we know, right? Oftentimes, we have very good flippers that know all that information. So it's nothing new to them, but we're going to pass it along anyways. The one other thing that we do well in Calvert is we provide our opinion of that end value. So it gives the investor another set of eyes on the end value. I'm a realtor, so I'm going to badmouth realtors right now a little bit. Sometimes realtors are looking for a sale, and they might give a number that's maybe not as real as they hope, and so an investor may use that advice and go, oh, there's lots of profit here, and then we look at it and go, no, I think there's not as much, and here's why, and then we go through the factors. Other things, simple things like don't renovate a place that's underneath a power line. Don't renovate a place unless you intend to turn it into a rental property that has a bus stop right out front of it. So things like that affect marketability, we're also going to give our opinion on. And again, it's our opinion. We're not always right, but we share that, and then that's another set of eyes on that information.
But I definitely would like to come back to that point you said about the bus stop, the power lines. We'll come back to that in a second, but I just want to, I really want to touch on what you said about the information side of this. And, if you are looking to get into flipping, or maybe you've done one or two, or you're getting started, it's everybody should be doing their analysis. There's no, single party that is really going to be responsible for providing an exact number on ARV or the location or the suburb. Like, there's so many opportunities that come up, and it just doesn't mean that you have to jump on every single one of them. You really have to look at the area, the location, and this comes back to the bus stops and the power lines. Like, exactly where does that house sit? What is around it? Is it on a corner? Is there a school nearby? Is it going to be busy traffic? Is it on a drive, a main drive? Like, you really, really have to look at that from a sale perspective before you even get into that property. But you also have to do your own research on comps, ARVs, on what's sold. Are they comparable to what you are going to build or renovate to? What is on the market now, right today, and watch that throughout your project as well. So really, from my perspective, whenever I get something from a realtor, I appreciate it and I look at it, but I always, from an unemotional perspective, I take that and I move on with my review. And then, anything I get from a banker, I'll take that and I'll move on with my review. And all of that information helps me as well as an investor determine what, if my thought process is close to where everybody else is landing. So I think it's really important that people understand that they need to do their own research as well. It's a team. It's really a team effort, is my thought. But yeah, location is key as well.
Yeah, I like that point, Brad. The way I look at it is the flipper is taking on all the risk. It's their name on the mortgage. It's their name on title. They got to do their homework. They have to be. They have to know enough to make their own conclusions and not depend on other people to make conclusions. They can get advice from people. They can get information from people, but they should be able to make their own decisions about the different factors on their given project. So that's, I totally agree, very important. our best flippers are very good at that. And I shouldn't even say our bad flippers. I'm going to say our inexperienced flippers are they take time to learn that that they have to take that information and and come up with their own opinion, because it's their investment, right?
And it's okay to take time to learn stuff, as long as you do learn it along the way.
Right. Again, back to my comment about, I like a little more meat on the bone on the earlier deals, because people make mistakes. You can't factor in everything. We're in a market right now that I think mistakes are going to be a little more tolerated because of what's going on with inventory. A year ago, you couldn't make mistakes and make a decent profit. You had to be on the ball. You had to get it at the right price. You had to stick to your budget, and you had to sell it fast. Now there's a little more, tolerance for a mistake here or there. But I think even the best flippers, they're going to make mistakes along the way. As long as you can minimize those, you're going to be a good flipper.
Yeah, and I mean, there's the saying that the money's made on the buy. It's maybe not that straightforward with flipping, because there's a massive cost control component to construction. There's the continual review of costs versus budget throughout the construction process. So for somebody that's really good at construction, that's half the battle. The other half is actually managing the spend while you're doing the project. Yep. And ensuring that you're not 100% spent against your budget, but you're only 50% complete the project.
Yeah, and things, like changing little things throughout the project. Oh, it'd be nice if I did this. It'd be nice if I did this. And when people get into that mode, all of a sudden their budget gets blown out of the water. You mentioned one thing that we saw with COVID is we saw costs of materials change quite significantly and quite rapidly. And if you're just starting a flip and all of a sudden your budget changes because of the materials changing or material costs changing, that's out of your control. You could have done as good as analysis as possible, yet there are factors that are going to come into play that you got to adjust for and work around, right? So that was a good example with COVID.
Absolutely. I mean, lumber is a perfect example of that right now. Lumber's increased again. I mean, even during our last project, lumber went from, it was around $4 for an 8-foot 2x4, and it's around $7. It was about $7.50 at the time of our project. So, I mean, there's yes, you carry a contingency. You always have a contingency and a bit of a backup fund for your project. But I mean, it just gets eaten up so quickly with these hikes in material costs.
Yeah, I mean, most people don't budget for what is that, $3.50 on $4?
Yep.
90% increase. That's not usually the contingency.
Yeah.
It might be 10 to 15%, not 90%, right? And I know that's only on materials, but that's a significant cost usually in renos, right? So yeah, it's a tough one.
So why don't we, Sherwin, I'm cognizant of time. Why don't we dive into an example here? I know you've got some stuff that you can share with us, and we can run through a real life example.
Okay, I'm just going to do a little maneuverment here, and I'll be speaking because I'm going to be looking over there. So in our flip program, I'll just go through high level details of what our flip program is. Okay. So we lend with as little as $10,000 down. We lend up to 80% loan to value on after repaired value. So when we're lending, we always require that down payment of $10,000. So our net mortgage, highest net mortgage is purchase price minus $10,000. We require the client to have the money to do the renovations and to carry the project to completion, as well as the down payment that they're putting in. So to illustrate that, I want to just talk about one that we've done. This is actually an Edmonton property, so bear with that. But you can see the before and after, and really what I wanted to highlight is the net profit of $40,500 in just over 3.5 months. So, and I'll talk about our flip analyzer. Our flip analyzer allows us to look at these deals ahead of time. This is retrospective. So, we're looking back at their budget. What did they do on their budget? What did they do? How long did it take? All that stuff, and how much did it cost? So in this scenario, you can see they opened up, this is just one picture, but they opened up the wall in the kitchen, made it a little bit more open. And throughout, this was I think like a 1,200 square foot bungalow-ish, where they did this, modernized it and made it look really good. But if we're looking at the project itself, so I'm just going to scroll down here. So the flip details: purchase price was $313,000. They put the minimum down payment of $10,000. They had a renovation budget. Their original renovation budget was actually a little bit higher than this. It was about $45,000. They came in at $53,000 when all was said and done. Purchase date to sale date was 109 days. They sold it for $448,300. They had a net profit of $40,500. Over on the right, we go into mortgage details. So we lent $303,000. Their interest rate was 15.5% when it's that small down payment of $10,000. They had a term. Our terms are 6 months usually, and they're fully open with interest only payments. Fully open, so you can pay us out whenever you sell it. The commitment fee in this case was $6,060. So, and that gets added to the loan. So it's not out of pocket. In this case, the total mortgage was $309,060. So just looking down here, this is actually a portion of our flip analyzer, but really the most important part. It analyzes all of your costs involved. So you look at our purchase costs on the far left. So there's legal costs, there's title insurance, then selling costs. The real estate agent fees are the common 7 and 3. They had a little bit of a real estate agent discount just because they do work with the real estate agent often. Not a lot, obviously, only $1,250 off the total bill. There's legal fees, there's title insurance again. Operating costs over on the right there, the monthly costs, and then multiplied by the number of months that took. So that's their total operating costs. Down here, there's the this is where we enter in the renovation budget timeline. So originally, I think we had it at that they were going to take 4 or 5 months total, and their budget was $45,000. So their profit was going to be a lot less overall. These are the numbers after the fact. So 1 month to renovate, 2.5 months to sell. Again, that's from listing it to it actually closing, and the renovation budget ended up being $53,000. This scenario shows an after repaired value of $448, purchase price of $313 with 10 down payment, and net mortgage is $303. Over here, the financing costs, 15.5 interest rate, a 2% financing fee. So interest costs per month is just over $4,000. Total financing costs in this scenario were $20,000. Down below is the most important part. The profit was just over $40,500. We talked about total cash needed and utilizing our flip analyzer to know what we're looking for when they get into a project, and that's this right here. In this scenario, it's $80,000. What I always like to point out is the return on cash invested. So when you're using our flip program, because of that small down payment, you're putting in a lot less into a given project. So, which benefits people in a lot of different ways. Oftentimes it means they can do multiple projects at once. Sometimes it means they can look for their next project before this project sells. For whatever reason, it becomes important to investors and flippers that do multiple properties. But if you look at total cash needed, so that's what they put in, they profited 40,000 in that 3.5 months. So their return on their cash invested was 50% or just over 50%. If you annualize, so using that same amount of money, that 80,272, and you did 3 projects, just over 3 projects in a year, an annualized return on that cash invested would be 173%. So basically what that's saying is using that same money, flipping multiple projects in a year, you're returning a huge amount on the money that you're putting into it. There are other lenders that will do flips. Like right from the start, flip, they know it's a flip. They know, you're not using, you're not telling them a lie. You're going in there, you're going to do the flips. They require a 35% down payment. So you got a lot more money in it. For some people, that means they can't do it because they don't have the money to put down plus do the renovations, right? For some people, that means they can't do multiple projects. But the other thing that we do is we look at challenging properties. So by challenging properties, I mean, oftentimes they're judicial listings. So they're as is, where is, where you can't put a condition on your offer. So oftentimes we can look at the property ahead of time. We can do our after repaired value, say, yeah, it's profitable and we'll do it at this purchase price. You're pre-approved at that number, go ahead, put in unconditional offer. So it allows clients to go be aggressive on an offer, go in unconditional. Sometimes they have to because it's a judicial listing. Sometimes they don't, but it helps them get the deal because they're unconditional and they can close quick. So oftentimes just having that in their back pocket allows them to win the deal with our scenario. The lender that I talked about that you could put 35% down, they require an appraisal. So they're not doing as is, where is type of deals. You can't go in unconditional with that product. So that's one of the main uses of our flip product is where it's those judicial sales, those as is, where is, and people can go in without conditions. Those often are if you want to call it the juiciest, those are often where you can get them at a really good price, put in your renovations and sell them at a good number to make a profit. So this is an example of our flip product that we did. I did this one. I can't remember. It's about a year, maybe almost 2 years now. I think I've done about 4 projects with this guy. So this was the first one. This one is where we did the full gamut of review. We did the app, the bureau, all that stuff. After that, basically, he sent me, here's the property I'm looking at. Here's my renovation plan, budget, timeline. What do you think? So it's really easy after that. The guy does awesome work. Easy to see that, especially he's a guy that I talked about earlier where he's an electrician and he used other trades to do the other parts. His son did the general stuff, painting, doing little things. But so he has that, that little group of people that he depends on to do these renovations, does a good job, gets in and out really quick. Like 3.5 months is a really good turnaround, especially at the time. Right now, I think you could do it even quicker, like especially that sales cycle of 2.5 months because of the inventory. So, there's better profit to be made when you're doing it quicker, right?
Sherwin, just look at the numbers here. Based on your loan amount of 303,000, did you assume that he had a lower ARV value when you were going in with him on this project? If you've loaned 80% loan to value, the 303 is a lot less than 80% of 448.
Good question.
Mm-hmm.
So we always require the minimum down payment of $10,000.
Mm-hmm.
So that's something that people will get confused on because they think that we'll lend up to 80% of the after repaired value. We lend up to that, but our maximum is purchase price minus $10,000.
Okay.
Okay.
Got it.
In the scenario where somebody might have equity in another property and they allow us to blanket another property, we can maybe lend them additional funds to actually do the renovations. And we usually do that in a draw type of product where, we'll give you, say if the rental plan is 75,000, maybe we'll give you 25,000, make sure it goes into the project, then give you the next 25 or maybe the next 50, just depending on the scenario. So there are scenarios where we'll lend more than the purchase price minus $10,000, but more often than not, it's this scenario where it's purchase price minus $10,000 net mortgage.
And the mortgage is secured against this particular property, correct?
It's secured against the property they're buying. Yeah.
Okay.
Yeah.
So-
And this scenario, actually, they sold it for higher than we originally thought the end value was going to be. We are conservative in our valuations. One of the reasons we're conservative is oftentimes you can look at an end value and say, I think, reasonably we can sell it for 430 to 450. We want to lend to you based on that 430 number. Because if there's profit at 430, there's a lot of profit at 450, right? So that's how we look at it. So we want to take the conservative approach, make sure there's profit there, and then everything is, you want to call it gravy after that.
So what are some things that people can do to avoid pitfalls, or what are some of the pitfalls that need to be thought about before getting into this? Because I mean, it's great, you can go through, run everything through the calculator, spit out some positive numbers, but I mean, like, how do we avoid pitfalls in these scenarios?
Yeah, we talked quite a bit about pitfalls so far. One of the biggest ones is not sticking to budget. So, if you choose halfway along the way to add this, or your materials change, or, so on and so on, budget can really affect your profit down the road. How do you avoid COVID? I don't think you can. So sometimes they're unavoidable, but adding new things to your budget is avoidable. Make a plan, stick to your plan. Make sure that you're following your plan. Another pitfall is using comparables that aren't really comparables. So I live in Woodbine in Calgary here. In Woodbine, there's single family detached houses from 200,000 all the way up to 2 million. And there's a lot in between. You can get the same size house in Woodbine in one area that's 100,000 to 150,000 less than that same size house, almost same style, everything, in another area of Woodbine. So knowing the community that you're selling in is really important, and making sure that your comparables that you're using are truly comparables. Thinking about things like we talked about. If there's a power line above, it's going to affect the value. It's first of all going to affect how many people want to live there. So right off the hop, the competition for that property goes down. So you got to think through things like that. If you're a corner lot, that's awesome. But if you're a corner lot on a boulevard that has crazy traffic, that's not awesome. So you got to think through that as well. So those are some. The other ones, again, renovating not to the community. I've seen that happen. More often than not, it's under renovating. So they didn't do the top-notch renovations, and they expect to get that high number that they're seeing that would normally be a really good comp, but they didn't. It's not a comp because they didn't do the same stuff. So that's another one that's common for us. And then the one that that really drives me nuts is when people list it way higher than they originally planned to. And when they do that, it usually means they blew out their budget and they're trying to recover their budget and make profit still, instead of getting out of it quickly and move on to the next one. When they do that, obviously you can see how the carrying costs can affect your total profit. You stay 1 month longer and all of a sudden that's another in this example, that's another $4,000, right? So, and that's just right out of your profit. So if you're chasing that top dollar, sometimes that's part of the problem. So taking too long to sell is really the pitfall. Other ones, unfortunately, getting into a project with the wrong partner. You got a JV partner, or you got someone that's going to do this renovation. All of a sudden, it turns out they're not going to do that, or they're going to charge you more for it, or something like that. Make sure you know who you're doing business with. That's unfortunate. Sometimes that happens to people, and then they learn and they move on and they get a better group of people around them. So I think those are the main ones. I think some stuff that comes up ad hoc that we, like COVID and how that affected materials. COVID, you and I were talking about this earlier, Brad, about people getting sick from COVID, right? I mean, you have that example. It affects your workforce and it affects how quickly you can do things. Right?
Yeah, there's a big knock-on effect there for sure. And even well, yeah, we did mention how it affected our team. Like it went through our whole team. It disabled the project for a certain length of time. But not only are you dealing with a shutdown from an installation standpoint, you're also dealing with the knock-on effect of maybe it's people not being able to enter the property now to do a measure for something like a countertop, for example, or maybe you're sick and you're not able to order stuff that you need to order. So then all of a sudden your delivery is delayed. So the knock-on effect, although you might be, sick or locked up at home for 2 weeks, it might actually cause a 6-week delay in something because it doesn't actually hit the site for 6 weeks. And then the knock-on effect from it not being ready is that maybe the tiler can't install the countertop. These are just examples. Snowfall. We also got hit with a snowfall, a big 40 centimeter dump in December, and tradespeople couldn't get to the project. They simply could not get out of their streets to get to the project. So, December was a complete write-off. We lost a whole month on the project. So, I think you really hit the nail on the head, Sherwood, when you said it. You just touched on, surrounding yourself with good partners. I think that's really, really important, and just good team members all around. And it really is the whole team. It's not just the tradespeople. It's your realtor, it's your lawyers, it's everybody that touches anything to do with your project. It's really, really important that everybody's in sync and everybody gets along, and it just creates that fluidity that makes projects successful.
Yeah, I agree.
So I mean, I feel like we could talk about this forever because I personally love talking about it. But what's the best way, Sherwin, if people are listening or watching that want to actually reach out to you, what's the best way for them to do that, to get involved?
Yeah, so easy, you can definitely share my phone number, my email. My phone number is 403-828-7162. Email is easy. It's my first name and then at chmic.ca. So either of those, I'd love to have conversations with potential flippers, or I'd like to pass you, if you're interested in investing in Calvert, I'd pass you along to our dealing reps that can speak to that. Always welcome a conversation. I love meeting new people that are enthusiastic about flipping. I love flip deals. It's my favorite product that we put out. What I love the most is seeing the end product. That's the awesome part about it. And then the other part that I love the most is we're not often wrong on end value, but I love when people prove us wrong, and maybe do those renovations just a little bit better than we thought they were going to be, and make more money than we thought they were going to. That's awesome too. Like, we just love that. So yeah, reach out to me. I'd be happy to go through it.
And all of the information will be in the show notes as well. And I know we didn't really get a chance to go into your construction mortgages and construction lending. Would you be open to another episode down the road, Sherwin?
Yes, we can definitely do that for sure. I know this topic we can go on and on for sure. So we can delve into that in another one for sure.
Excellent. I look forward to that.
Awesome. Well, this has been absolutely fantastic. Thanks so much for your time, Sherwin. We really, really appreciate it. You've got last word.
Last word is, I really appreciate you guys having me on here. Always awesome to share our product and share our knowledge with people, and look forward to hearing from people that are interested in it.
Great.
All
Well,
right.
thanks again.
Thank you, Sherwin.
Thank you guys.
Have a good night. Hey everyone, thanks for listening. Just a couple items before we head off. We wanted to let everyone know that we're starting our monthly live events again. It's a great place to connect with other real estate investors and to learn from our various guest speakers. They will be hosted on the last Tuesday of every month, and to sign up or find out more, please visit the events page at cwho.ca. I'll see you guys next time.
Thank you for listening to the Commonwealth Home Ownership Podcast. Be sure to check out all of our past episodes and our ever-growing library of content at cwho.ca. Until next time, remember to get out there, take action, and create a life of wealth by design.